What's up, everybody? It's the Common Sense Investor coming at you with another video. And I did my first part on NSCC 2022-003. We got to page 3. I took a nap. I'm back. But before I got started, I wanted to try to catch up on some news and see what was going on. And I found this article here. Embattled hedge fund Melvin Capital weighs unwinding current fund to start new one, sources say. Okay. Now, this ain't new news. People are reporting on this right now on YouTube. Thank God I don't have a firearm. But what I found interesting was the connection I made. Just as soon as I read this article, I'm like, okay. People say that means they're going to cover. Okay. And they're big shorted on AMC. Okay. What does that have to do with NSCC 2022-003? I'm going to show you now. We get to this part right here on page 7 of 377, which means I got 370 pages to go. We find the liquidity drain risk mitigation section. Okay, and mitigation means basically they're going to be the middlemen with the liquidity drain risk, which you'll understand that in just a second. Liquidity risk may also arise if the context of a stressed market scenario, borrowers or lenders concerned about their counterparty's credit worthiness seek to unwind their securities. All right. And I thought, wait a minute. And I went back and looked at this article and I said, well, I'd be goddamn, they're unwinding their current fund or their current securities. And here it is mentioned right here that in the case that a borrower or lender concerned about their money seek to unwind their security lending transactions and obtain the return of their cash, collateral, or securities. This occurred to a certain extent in 2008 when borrowers began demanding to return borrowed securities in exchange for cash collateral the borrowers had posted to institutional firm lenders. Okay. What does that mean? Basically, it means somebody gave Melvin Capital money. Melvin Capital invested that money. Now shit's going south. And the person that lent them the money is going, hey, we need our money back. So they're going to unwind it, sell off their securities, give back the money to their investors, and start all over. That's what the liquidity drain risk mitigation part is about. They said that they know this happens as it happened in 2008. All right. These runs may require runs, meaning people running, telling them they want their money back, may require institutional firm lenders to quickly sell off securities that are the subject of their cash reinvestments to raise cash to return to the borrowers, thereby creating potential fire sale conditions with respect to the reinvestment securities as described above. Okay? What this means is when people start unwinding their position, like it says here, Melvin's going to do, then what happens is Melvin's going to end up having to sell off their securities in order to give the people their money back, to close out their positions and get their money back and give to their investors. Simply put, that means they're going to have to sell their Apple, their Microsoft, their anything that they have to pay off what they've done so they can give their money back to their investors. They're unwinding, they're closing it down, door shut. Simple as that. I thought it was interesting that the Melvin Capital situation that's going on right now is mentioned right here, and they're talking about how this new rule is going to stop a fire sale or the rush to sell all of their shares on the open market and cause the market crash. They said this is going to stop that. So let's see how. Let's see, next paragraph. Watch this. The NSCC believes that having SFTs be centrally cleared by NSC would lower the risk of a liquidity drain in a stress scenario. All right. It says here again, it believes that they don't have the power to be the central clearing for SFTs. All right. This between Melvin Capital and Citadel. Citadel gave them $5 billion, I think it was, trying to keep them alive. Now they said we need our money back. Y'all know, y'all heard the story. We need our fucking money back. So that causes the fire sale. Well, NSCC says that if we would have been the referees in that dog fight, we could have had them give us the shares. We would have gave them the money and they could have paid Citadel. Then when the time came and they wanted their shares back and they had the money, they give the money to the NSCC because they're the middlemen now, and they give them back their shares. But they pay an interest rate for that privilege. That is right here. They don't have that power. Right now, when two dogs go to fighting, it's the best dog that wins. And the NSCC is saying, no, we're the referees now. If you need to give Citadel $5 billion or 500 million, whatever they gave them, I forget. And instead of selling your shares and paying them, you give us the shares, we give you the money, you pay them, and then you give us the money back. That's exactly what's going on here. And that's a prime example of what's going on with Melvin right now. So there's your Melvin Capital and your NSCC 2022-003. Golly, if you try to remember all these. Update. And I love y'all. Be blessed. Look, this only means they're going to be the referees in this dog fight. As this hedge fund goes to falling, instead of letting them sell their shares on the open market, it'll come over here and they'll give them the money. Y'all wanted a printing press. There it is. Love y'all. Be blessed. See you in the next video.